Hey there, financial warriors. It's your boy, Boss, back with another no-holds-barred, straight-to-the-gut episode of Boss Economics World. Buckle up, because today we're not just talking about your everyday economic fluff, we're diving headfirst into a global financial horror show that's got investors sweating, governments scrambling, and the average Joe wondering if his savings account is about to go poof. That's right, folks, we're tackling the headline that's got Wall Street quaking in its loafers: financial crisis looms in just 50 days. Sounds like a Hollywood blockbuster, doesn't it? Dollar devaluation, U.S. debt exploding, stock markets crashing. Heck, this script is juicier than a season finale of Game of Thrones. But hold your horses, people. While the average person might be trembling under their IKEA duvet, those of us with a shred of financial literacy see something else: a once-in-a-decade chance to flip the script, make bank, and come out on top while the world burns. So, grab your calculators, hit that like button, ring that bell, and let's rip apart this doomsday prophecy layer by layer, exposing the crisis and the opportunity behind it. Ready to awaken your wealth? Let's dive in. First, let's talk about the spark that's threatening to ignite this whole financial dumpster fire: U.S. Treasury debt. In June 2025, just 50 days from now, a staggering $6.5 trillion in U.S. debt is set to mature. That's right, folks, $6.5 trillion, a number so big it could make even Elon Musk blink twice. To put this in perspective, according to the U.S. Treasury Department, the total U.S. national debt has already ballooned past $35 trillion as of October 2024, with short-term treasuries, those maturing in a year or less, making up about 22% of the pile, or roughly $7.7 trillion. Now, this $6.5 trillion chunk hitting maturity in June. It's mostly short-term debt issued during the COVID-19 pandemic, when the government was throwing money around like confetti to prop up the economy. Back then, the Federal Reserve slashed interest rates to near zero and unleashed infinite QE, quantitative easing, or as I like to call it, the Fed's magic money printer. They bought up treasuries like a kid in a candy store, and yields on those bonds were laughably low. For example, 2-year treasury yields in 2020 dipped to a microscopic 0.1%. But oh, how times have changed. Fast forward to 2024, and the Fed's aggressive rate hikes to combat inflation have sent yields soaring. As of November 2024, the 10-year Treasury yield is hovering around 4.6%, a level not seen since the early 2000s. What does this mean? Well, Uncle Sam now has to roll over that $6.5 trillion in debt at much higher interest rates. Let's break it down with a real-world analogy. Imagine you borrowed $1 million for a mortgage in 2020 at 1% interest. Your monthly interest payment was a measly $833. But now, you need to refinance, and rates are at 5.5%. Suddenly, your monthly interest jumps to $4,583, over 5 times higher. Now scale that up to $6.5 trillion. If the U.S. rolls over this debt at 4.6% interest, the annual interest bill alone jumps by nearly $300 billion. And that's just the interest, forget about paying down the principal. But here's the kicker: the U.S. government is already broke. According to the Congressional Budget Office, CBO, the U.S. posted a $1.8 trillion budget deficit in fiscal year 2024, and projections for 2025 show it ballooning to $2 trillion. Translation: Uncle Sam is already borrowing just to pay the bills, think rent, Social Security, defense, and now they've got this $6.5 trillion monster knocking at the door. This, ladies and gentlemen, is what we call robbing Peter to pay Paul, except Peter's already filed for bankruptcy. Now, here's where the plot thickens. Back in the good old days, like pre-2008, U.S. Treasuries were the golden goose of global finance. Everyone and their grandma wanted a piece of that sweet, risk-free debt, even when yields were a measly 1%. Foreign investors, central banks, you name it, they were all in. But oh, how the mighty have fallen. According to the U.S. Treasury's latest TIC, Treasury International Capital, data, foreign holdings of U.S. debt have plummeted from a peak of 50% in 2008 to just 29% as of mid-2024. Who's bailing on Uncle Sam? Well, Japan, the largest foreign holder of U.S. debt, is sitting on about $1.1 trillion but has already dumped $70 billion in the first half of 2024 alone. China, the second largest holder, has slashed its holdings from a peak of $1.3 trillion in 2010 to just $770 billion as of September 2024, the lowest in nearly 2 decades. And it's not just them. Bloomberg reported that in the last week of October 2024, global investors yanked $19 billion out of long-term treasuries, the biggest weekly sell-off since early 2022. Why the mass exodus? 2 words: dollar distrust. The U.S. has spent the last few years torching its own credibility. Remember 2022, when the U.S. froze Russia's foreign reserves after the Ukraine invasion? That sent a loud and clear message to the world: your dollar-denominated assets are only safe, until we say otherwise. Add to that the trade wars, tariff tantrums, and political circus in Washington, and it's no wonder global investors are running for the hills. So, where's all that money going? Straight into gold, Bitcoin, and even other currencies. The World Gold Council reports that central banks bought a record 1,136 tons of gold in 2023, with 2024 on track to hit 1,200 tons, driven by heavy buying from China, Russia, and India. Gold prices have skyrocketed, hitting $2,750 per ounce in November 2024, up nearly 30% from early 2023. Meanwhile, Bitcoin, the poster child of decentralized finance, has surged past $90,000 as investors flee fiat currencies. This isn't just a trend, folks, it's a global vote of no confidence in the dollar and U.S. debt. Now, let's talk about the dollar itself. You might be thinking, but boss, isn't the dollar the king of currencies? How could it possibly fall? Well, wake up, sheeple. The dollar index, DXY, which measures the greenback against a basket of major currencies, has already slid from a 2022 peak of 114 to 104 as of November 2024, a 9% drop. And analysts at Goldman Sachs are warning it could sink to 95 or lower by mid-2025 if the Fed starts cutting rates again. Here's the dirty little secret: dollar devaluation is actually a feature, not a bug, of the U.S. debt machine. Why? Because U.S. debt is denominated in dollars. If the dollar loses 10% of its value, the real burden of that $6.5 trillion debt shrinks by $650 billion. It's the ultimate get-out-of-jail-free card: screw over global investors while lightening your own load. But for the rest of us, dollar devaluation is a nightmare. If you're holding dollar-based assets, U.S. stocks, bonds, or even cash under your mattress, your purchasing power gets torched. And for countries like China and Japan, which hold massive dollar reserves, the losses could run into the hundreds of billions. Meanwhile, gold and other hard assets are having a field day. Morgan Stanley predicts gold could hit $3,200 per ounce by late 2025 if the dollar keeps sliding. Oh, and guess who's secretly winning big here? Yep, Uncle Sam again. The U.S. holds 8,133 tons of gold in its official reserves, the largest stash in the world. At $3,200 an ounce, that's worth over $840 billion, a cool $200 billion more than it was worth in early 2023. So, while the U.S. screws over the world with a weaker dollar, it's quietly raking in profits on its gold hoard. Talk about playing both sides of the chessboard. While gold and crypto are popping champagne, the stock and bond markets are in a full-on panic attack. In 2024, the U.S. stock market has already taken a beating, with the Dow Jones, S&P 500, and Nasdaq down 12%, 15%, and 18% respectively from their peaks, according to FactSet. Globally, stock markets have shed a jaw-dropping $22 trillion in market cap this year alone. The bond market? Even worse. With Treasury yield spiking, bond prices are tanking. The Bloomberg U.S. Aggregate Bond Index, a broad measure of the bond market, is down 14% in 2024, its worst performance since the 1980s. Why the carnage? Because investors are losing faith in both U.S. economic stability and the safety of its debt. When yields rise, bond prices fall, and with the Fed keeping rates high to fight inflation, the pain is only getting worse. This, my friends, is what we call a stock-bond double kill, a rare and terrifying scenario where both asset classes get slaughtered simultaneously. And the root cause? A toxic cocktail of sky-high debt, dwindling confidence, and a government that's acting like a kid maxing out daddy's credit card. Now, let's add some political spice to this economic stew. If you thought the debt crisis was bad, wait till you see what happens when Donald Trump takes the White House again in January 2025. His big plan? Slap 10% 20% tariffs on virtually every major trading partner, all in the name of bringing manufacturing back to America. Sounds patriotic, right? But let's look at the data. The Peterson Institute for International Economics estimates that Trump's tariffs could slash global trade by 5% in 2025, wiping out $1.8 trillion in economic activity. U.S. exports, especially agriculture and manufacturing, would take a massive hit. For example, China's imports of U.S. soybeans have already fallen from $14 billion in 2017 to $7 billion in 2023, thanks to earlier trade wars. With new tariffs, that could drop to $3 billion or less. Worse still, tariffs would supercharge inflation. The IMF projects that global inflation could rise from 3.5% in 2024 to 5.2% in 2025, with U.S. inflation potentially hitting 6.5%. Higher inflation means higher interest rates, which means even more pressure on that $6.5 trillion debt pile. But here's the conspiracy theory angle: what if Trump's tariff tantrum is just a smokescreen? A weaker dollar and global market chaos could actually help the U.S. manage its debt crisis by devaluing its obligations and forcing the Fed to cut rates and print money. It's the ultimate smash and grab, wreck the global economy, then swoop in to buy up cheap assets. Genius or diabolical? You decide. At the heart of this storm is the Federal Reserve, and boy, are they stuck between a rock and a hard place. Come June, when that $6.5 trillion debt matures, the Fed has two options, and both are terrible. 1. Keep rates high. This would attract foreign capital to buy U.S. debt, stabilizing the Treasury market. But the cost? A full-blown recession. Higher borrowing costs would crush businesses, tank the stock market, and send unemployment soaring. Goldman Sachs estimates that if the Fed holds rates at 4.5%, U.S. GDP growth could fall to 0.5% in 2025, or even go negative. 2. Cut rates and print money. This would lower the cost of rolling over that $6.5 trillion, letting the Fed buy up treasuries with freshly printed dollars. Problem solved, right? Wrong. The cost is runaway inflation and a dollar crash. JP Morgan predicts that if the Fed restarts QE, inflation could hit 8% and the dollar index could plummet below 90. So, what will the Fed do? History gives us a clue. In 2008, they slashed rates to zero and launched QE. In 2020, same story. Every time, the Fed chooses to save the system over saving the dollar. So, mark my words, come June, the Fed will hit the panic button, cut rates, and fire up the money printer. The U.S. debt crisis gets kicked down the road, but the rest of the world? Buckle up for turbulence. Now, I know what you're thinking, boss, this sounds like the end of the world. What do I do? But listen up, folks, every crisis is a golden opportunity for those who play their cards right. Remember 2008? Warren Buffett scooped up bank stocks at rock-bottom prices and made a 10x return in a decade. Remember 2020? Investors who bought tech stocks at the COVID crash lows saw 5x gains in 3 years. This time, it's no different. Here's how you can ride the wave. Before the crisis, now to June 2025 the dollar will keep sliding, and safe haven assets like gold and Bitcoin will soar. Gold could hit $3,200, and Bitcoin might break $120,000. Cash and safe havens are king here. During the crisis, June 2025 the Fed will cut rates and print money, triggering a fire sale in stocks and bonds. This is your chance to scoop up quality assets cheap. Think big tech ETFs, undervalued Chinese stocks, or even distressed real estate. After the crisis, July 2025 onward as tariffs and inflation wreak havoc, the dollar might rebound temporarily. That's your cue to shift some safe haven gains back into dollar-based assets for the next bull run. Here's Boss's battle plan for regular folks like you and me. 1. Hold cash. Keep 20% 30% of your portfolio in cash to pounce on bargains during the crash. Historically, the best buying opportunities come when markets drop 30% 50%. 2. Safe havens. Allocate 30% 40% to gold, via ETFs like GLD, and Bitcoin, via ETFs like BITO. These assets thrive in chaos. 3. Diversify globally. Put 30% 40% into global core assets. Think US tech ETFs, QQQ, Chinese blue chip ETFs, MCHI, or even European value stocks. 4. High risk plays. Reserve 10% for speculative bets, options, leveraged ETFs, or meme stocks. But remember, this is Vegas money, be ready to lose it all. So, there you have it, folks, 50 days from now, the $6.5 trillion U.S. debt maturity could be the match that lights the global financial powder keg. Dollar devaluation, gold surges, stock bond carnage, it's a doomsday script straight out of Hollywood. But behind the scenes, it's all a giant game of wealth transfer, orchestrated by the U.S. government, the Fed, and Wall Street's big dogs. For us regular folks, this could be the biggest wealth-building window of the decade. Stay liquid, stay safe, and stay sharp. Will Boss be right on the money? Time will tell. But one thing's for sure, in this game, fortune favors the bold, and the informed. Don't forget to like, subscribe, and ring that bell for more financial wake-up calls. Until next time, this is Boss, signing off. Remember, wealth awakening starts right here at Boss Economics World.